Thinking about retiring in Oregon, the scenery is beautiful, the people are great, but the taxes can be brutal if you're not prepared. Between Oregon estate tax, Oregon income tax, Medicare costs, a wrong move can lead to a big financial hit. But today we'll walk through the most overlooked areas of retirement planning in Oregon, the smart strategies to help plan for taxes, make better withdrawal decisions, and help you enjoy your retirement. Spend more time on the things that are important to you, family, travel, and just having less money stress. My name's Garrett Dresen. I'm a financial planner based here in Wilsonville, Oregon. I've helped over 100 families, retirees, business owners build financial plans to our unique state rules. Let's start by going over what we'll cover today. So we're gonna talk about Oregon estate tax. So a big concern for a lot of people. Even modest estates can be impacted by this, and we'll talk about what that means. And key estate planning documents that you should have. We're gonna talk about the Oregon income tax, how it affects retirees, smart tax planning. We're going to talk about all the acronyms, RMDs, QCDs, Roth, and then Medicare premiums, talking about that. And we'll be talking about spending as well. So a lot of retirees spend too conservatively, really, too. So we're going to talk a little bit about that, and then how to build an Oregon retirement plan. So let's start off with the Oregon estate tax. So this applies to estates over $1 million. So you could see the chart over here, and it starts at anything over $1 million of your estate too. So pretty low threshold given property prices in Oregon. And even if you just have a basic retirement, it can still impact you. And there's no portability between spouses. So essentially what this means is it's 1 million for a couple. Like if one spouse passes away, you don't have 2 million. So that 1 million covers both of you. And it can, like I said, it can even impact really modest estates. So even if you just have a basic home here in Oregon where home prices are really expensive and some investments, this will still impact you. And you'll have to, starting at $1 million, anything over that, you'll pay 10%, and you can see the sliding scale here. And this is not tied to the federal estate exemption, and that's 13.99 million in 2025. Doesn't affect most people, but the Oregon one definitely affects a lot of people here in Oregon. And so some planning tips for this: consider trusts. So there's one strategy called a bypass trust or an AB trust, and it just depends on your account structure if this makes sense to implement. But essentially it allows you to move money over when one spouse passes to avoid some of that Oregon estate tax. There's some complications to it, but it's something to look into and consider and talk to your attorney and financial planner about. And then gifting strategies. This is the one I'm the biggest fan of, really, because it allows you a lot of flexibility. So if one of your big goals is to move some money to your family members or to people you care about, you can be gifting as time goes on. And don't obsess over this Oregon estate tax. It's okay to pay some. I've seen people obsess way too much and they really want to get their assets below that $1 million threshold, but it's just something to consider in your plan. So maybe you might be gifting a little bit, but don't really obsess over this. And some people use life insurance to manage this liability too. It's not something I work with a lot, but it is a strategy that you could look into as well. And then estate planning. So, talking about a will versus a trust. So, trusts help avoid probate and, offer a lot more privacy than just having a will as well. So, if you were to pass away and you just have a will, all of that is public knowledge. So a trust will mitigate that. And a trust also provides a lot of control as well. So if you want to put stipulations on how people inherit the money, trust is really great for that. And here we're talking about a revocable trust as well. So one misconception is that it saves a lot in taxes. A revocable living trust doesn't save in taxes, but it just helps with time, with stress, and the things we talked about before too. So the key documents to have in place, will or trust. Typically, if you have a trust, you'll have a will too. And then power of attorney as well. So, someone to act on your behalf, and advanced directive for healthcare as well. So, being able to make those healthcare decisions, someone be able to make that on your behalf. And then when people do get a trust as well, it's really important to title your assets correctly. So, when you get a trust, you have to update your investment accounts, for example, your bank accounts. So just a reminder to do that. And usually attorneys they don't have the time to follow through on that. So just make sure that you do that. Usually they'll help put your home in the trust, but the investment accounts, bank accounts is really up to you. And then Oregon state income tax as well. So Oregon does tax most of retirement income. So traditional IRAs, anything you take from there, 401ks, pensions, but it does not tax Social Security. So federally it's still taxable, but Oregon tax you will not pay on your Social Security income. And there's no sales tax in Oregon, which is great, but income tax does go up to 9.9%. And you can see the brackets here over to the right. And most people will fall into that 8.75 bracket, and it starts at a pretty low income, you can see here. So it's definitely a pretty hefty state income tax. And then tax planning opportunities. So managing RMDs. So these are required minimum distributions. And this is on your IRAs, your 401ks typically. And there's some complications with the rules with this, but basically what RMDs are is when you reach a certain age, the IRS says, okay, it's time to take some money out of these accounts and pay taxes on it, of course. And if you're born before 1959 or later, then so you have to take RMDs at age 73. And if you're born in 1960 or earlier, you'll have required minimum distributions at 75. And then qualified charitable distributions. So these are QCDs. You can do these at 70.5. And what this is a donation directly from your IRA. So it's basically taking this pre-tax money and gifting it to charity. So this is a strategy to help reduce the amount that you pay taxes on from your required minimum distributions. And it's a good tax efficient way to gift. And then sequence of withdrawals too. So, typically there are 3 buckets of accounts. There's taxable account, a tax deferred, just like your IRA, and then tax-free, which is typically like a Roth account. And, a rule of thumb, it's never a solid rule, but, starting taking money from your taxable account first, then your tax deferred, and then your tax-free. So in that order is typically what you like to do withdrawals, but you can be pretty savvy with that for tax planning purposes if you're close to a tax bracket. So that's the nice rule of thumb, but be flexible with it as well. And then projecting your lifetime tax bracket as well. So this is something I'll show an example of here, but it's really important when you're doing tax planning to think about, what your taxes are, your tax bracket is now, and what you think it will be in the future as well. Whether it be early retirement or if you're never going to work again, just really like thinking about the future of your tax bracket. And run an analysis annually as well. Typically, you can coordinate with your CPA. Financial planners typically do a lot of this coordination because CPAs just don't have a lot of time. So this is something that we do for clients as well. We'll project people's tax brackets and coordinate with the CPA if there's any adjustments that need made. So you can see this example of the tax bracket here. This is projecting out someone's tax bracket. So you can see they're working right here, and then there's a gap here. This is between their income and like when they'll start Social Security, for example. So one thing you can do is kind of, plan around this low tax bracket. And then up here, this is when required minimum distributions kick in. So you could see, this person in particular looks like they have a lot of pre-tax accounts, so they have a lot of required minimum distributions. So this is something that we could plan around pretty effectively. And then this is an example of someone's current tax bracket. And this is long-term tax bracket, and then this is year to year as well. So this person is in the 24% tax bracket. So just depending on their lifetime tax bracket, planning around that, you can see they have around $100,000 left in that 24% tax bracket. So that might be something to plan with, just depending on their situation. And then Roth conversions. So this is converting pre-tax retirement accounts to Roth IRA. So you'll have to pay the taxes on this, but the benefit is that you pay the taxes now, and then the thought is that it grows tax-free for the future. So, this is, again, you'll be coordinating Roth conversions with your current tax bracket and your future tax brackets, and it benefits tax-free growth, and you don't have required minimum distributions on Roth IRAs. And then, yeah, converting in those lower year tax brackets. So for example, early retirement before required minimum distribution. So this is a prime example of when a Roth conversion could make sense. And something to look out for is the Medicare premium thresholds. So we'll talk about this in the next slide, but if you convert a lot in your Roth IRA and you're 65 or older, then you could potentially put yourself in the next Medicare premium bracket. And you can see here, this is the Medicare premium brackets for 2025. And premiums are income based as well. So you can see on the brackets here what the income thresholds are. So this is just something to really be aware of when you're doing your tax planning, if you're doing Roth conversions. And even $1 over this limit will mean you'll have higher premiums. So really want to be careful of this. And Roth conversions and capital gains can spike your income. So just be really careful about that. And then you can also use tax planning to, let's say you're taking all your money from your IRA right now, but instead you can take some from your taxable account and maybe reduce that Medicare premium that you're paying as well. So being really strategic about your withdrawals, just thinking about that. And then, are you spending too conservatively too? So many retirees, they underspend out of fear. A lot of times, people, they're very successful because of the habits that they've instilled, because they're such good savers, but it's really hard to flip that switch and, go from saving to spending and enjoying the fruits of your labor. So it's something to really be careful of. And I see with a lot of my clients, once you reach critical mass, your money starts working harder than you do. So for example, like a $1.5 million portfolio, if it were to return at 6%, for example, then that would be $90,000 a year without touching principal. Usually that's a pretty decent income for people. And then if you add Social Security on top of that, that's a pretty critical amount of money, and it adds up. So proper planning, really helps you, if you think about this, just spend more confidently if you're running scenarios on this, and, avoiding saving money that you'll never use as well, because you don't want to be the richest person in the graveyard. So what I recommend people do is they use projections and run scenarios. So, project out what you think your portfolio could generate, project out what you think inflation's going to be, your living expenses, any future goals that you have, and run these projections as well. So what if the market drops? What if the portfolio is less? And what if healthcare costs increase, living expenses increase? What about long-term care? All these things to think about. What if you spend more in your 60s even? So yeah, run scenarios and really just project out what you could have left at the end, because you don't want to overspend, but you really don't want to underspend either and not enjoy life, right? So your Oregon retirement game plan. So, understand how Oregon taxes impact your plan, income taxes, estate taxes, the Medicare premiums. Just think about all those things with what you want to do. Review your estate documents. If you've had your estate plan done 20 years ago, it might be time for an update as well. And then consider Roth conversions as well. If you have, a lot of people have a lot of pre-tax money more than anything. So just think about that if that makes sense for you. Talk to your CPA and talk to your financial planner. And then plan around the Medicare premium threshold as well. Just understand how that works, where your income is. In retirement, if you're going to have to pull a lot of money from your IRA, is that going to increase your premiums? What's that going to look like? And then use projections to see how you can spend more confidently as well. So you want to think in like abundance in retirement, right? You don't want to be like thinking, oh my gosh, this is all I have. But really running those projections helps you open up and understand those scenarios. And work with a team as well. So working with a certified financial planner, they're typically going to be like the quarterback of this situation, coordinating and whatnot. Having a CPA is really great as well, an attorney, and align your income, tax, and estate strategy. Like I said, the CFP should really be the quarterback in understanding what's going on in each of these areas. And update your plan after major life events as well. So, before retirement, during retirement, if you're downsizing, if you get an inheritance, if health changes, really be on top of these things and thinking about how you can take advantage of some of these opportunities. So if you have any questions or you want a personalized retirement plan that takes all these things into consideration, feel free to reach out and schedule a complimentary strategy session below.